Hey YouTube, this is Zach with Achilles Financial. Today we're going to be covering STEM Inc., which trades on the New York Stock Exchange under the ticker symbol STEM. This is a channel favorite. I've been covering them since STPK, their original SPAC merger, announced that this was going to be a combined entity. And this is one of my favorite stocks that I currently cover and one that I am long on. So that is full disclosure. They are associated with it. Also, in the interest of disclosure, I am by no means a financial advisor. I'm just some guy on YouTube, so make sure you do your due diligence. And anything I say is by no means a recommendation, even if it sounds like it may come across as one. The platform I'm using today is TD Ameritrade, utilizing their functionality here from a summary perspective, as well as I do plan on utilizing STEM Inc.'s presentations from their Investor Day in May, covering their Q1 earnings. So, with all that being said, if you find this type of content helpful, please consider leaving a like and subscribe, as it really helps my channel to grow and it helps incentivize me to produce more content like this. So, STEM Inc., this is a stock we've been covering for quite some time and has had quite the moves over the course of this calendar year. I'm going to focus on some of those moves at the beginning of the year, as it helps to put into perspective kind of where the stock is today. Currently, based off of the Q1 earnings report, the trailing 12 months revenue, which is money that has come in and has been delivered on, by my estimate based off of their seasonality projections, is sitting right at $48.7 million in trailing 12 months. And the company has a total valuation on the market capabilities of right at $3.5 billion. So if you do some of the math there, they are currently rocking a very high valuation in terms of price to sales. Because they are not profitable, they are currently not sporting a price to earnings ratio that you can see here. The large reason that they're not profitable is due to a significant amount of warrant exercise volume that they saw in Q1, and we'll talk about that here momentarily. The reason why I want to talk about some of the earnings moves that could be expected here is that when the stock was originally announced, it shot up and was actually holding around the $27 range after it was originally announced, and then it started these moves higher. So we saw at one point the stock actually traded above $50 a share, hitting a high of $51.49, and has then come back down. At one point it hit as low as $16 a share. We were watching and talking about this live in the Discord in the description down below, where I cover all of my trades. Now, there's been a lot of optimism associated with STEM Inc. and the infrastructure bill that is currently going through the Congress. And the reason for that is because obviously battery tech, it would be heavily involved in infrastructure. You can see since that rise and then back into that fall, we've seen this very tight range over the past 2 to 3 weeks between that $27 and $29 a share. So it's been kind of bouncing around. The reason why I've liked this is because we've been selling covered calls on the stock due to the high valuation and due to the fact that you can see that the stock likes to come back to this trend line right here. I think that there is a lot of power in kind of holding this range, selling those covered calls, which have quite a lot of volatility. And what I mean by selling covered calls is if you own 100 shares, you can sell call options for the right to buy your shares as a designated price and point in time. So that's what I've been doing here with STEM shares over the course of the past 2 weeks. I've highlighted all of my trades in the Discord, again in the description down below. So what is the expectation associated? Are we going to break up where we look kind of, hey, we may have been consolidating? Are we going to break down because we're just continuing that downtrend that we see from over here and even all the way back from the March or the February high going back down? So there's a lot of capabilities associated here. Again, one of the things that I would highlight is the company boasts a very high valuation. So you can see the cash has been decreasing as they've continued to make some huge payouts. That in and of itself is concerning. Now, one of the reasons why there have been some significant payouts is because they've been exercising those warrant options, where they're buying back those warrants saying we don't want you to have to provide us more money, and that tends to bode very well for the stock, because that means that the company is confident that their balance sheet will be able to hold on or be able to produce profitably. That being said, as you can see, with a cash balance really of about $426,000, with more of the long-term assets or investments here sitting right at $383 million, that is not very liquid. So what we're going to be focusing on here is, hey, what can we do with this $426,000 and how can we use that going forward? So overall, balance sheet is in a very strong position. The only concern is that they have had to make some significant investments into building this pipeline that they now have. The good news is if we look on a quarterly basis, we don't have that total revenue available inside the STEM Inc. chart because it was after Q1 that they went from STPK to what is now STEM. So a lot of the numbers here, including what we just saw on the balance sheet, are still going to be a little skewed. So we're going to move past that here as they become STEM and we look at their presentation. But the important thing to note is that they don't have a lot of history as a public company. Now, that's not always a bad thing, but it does showcase that the company is largely unaudited historically, and there's a lot of numbers that will highlight, hey, this is GAAP versus non-GAAP. So why do I like this company so much if they don't have a lot of information readily available on websites such as TD Ameritrade? The first thing I want to talk about is some of the analyst coverage that they've gotten so far. So all in all, so far, STEM has not gotten a significant amount of coverage from the analyst world. They haven't gotten a lot of love. That's largely because this stock is relatively not well known in the investor community, which is why there's not a lot of people who are currently holding on to these shares from an overall percentage of the marketplace. It's also not included into major indices such as the S&P 500 and the Russell 500 or even Russell 1000. I believe it was just added into the Russell 2000 about 3 weeks ago. Now we do have 3 people who have initiated their calls on the stock. You can see here 3 of them from Goldman Sachs, Credit Suisse, and Susquehanna. The important thing to note is that they all gave them a rating of buy, and they've given very attractive price targets, and you can see that here. The reason is because this company is showcasing an expected huge increase in overall revenue as well as overall potential profit. So let's go over and take a look at the actual expectations associated with the company from the investor deck. So what you see here is the investor statement from May 2021 covering the Q1 earnings. I'm going to go through very quickly and focus on the financial forecast. So as of Q1, they actually brought in $15.4 million. The expectation was similar to Q2. They were expecting to bring in 5 to 15%. So this is about 10.5% of the total expected revenue of $147 million. Again, this is a huge increase over what they did last year. So you can see revenue for Q1 2020 was 4.1 million right here, and you can see that revenue for Q1 2021 was triple that, 15.4 million. So the expectation here is to bring in another 5 to 15% of total revenue in Q2, and then 20 to 30% in Q3, and 50 to 60% in Q4. The reason why I highlight these numbers is because what I've been saying since the Q1 earnings announcement is this quarter, I don't think we're going to see a big move in the stock, whether up or down. The reason being is that they've given themselves a wide margin here, as well as B, I think that this is already locked in due to the fact that they've already developed and they have a significant amount of pipeline that they're currently working on. So the number I'm expecting right here is going to be, for my expectations, I'm going to call 19 million in Q2 2021 revenue. Now I could be off, it could be back in this 10 and they'd be spot on with the 5 to 15%, but I think we're going to be closer to the upside. I'm going to look for 19 million. Anything less than that, I think the stock may lose some of the volatility associated with it, but all in all, I don't think that that's a huge deal. The big growth quarter we're going to be looking for is, again, that 20 to 30% where we could see the $50 million to $60 million quarter, and this one's going to be when we see that $75 million quarter to potentially see a beat. The reason why I highlight all this is because they have that seasonality. They've built up a massive pipeline, and they will need to go and deliver on it. The good news is we could see a profitable quarter this year. You can see the targeted EBITDA, earnings before income taxes depreciation, is right here of negative 25 million. The large loss that we saw in Q1 this year of that $82.6 million was strongly tied to the fact that they had to go and purchase back all of those stock warrants that they were utilizing. The good news is they don't anticipate doing that again. They have a huge backlog. This is as of Q1, $1.43 billion. And so they're going to continue to develop this contracted AUM, which essentially means their gigawatts that they currently have under management. They're going to continue to decrease, and that's going to be a big deal for them because this is essentially how they become an asset manager in terms of electricity. The capability to grow is massive. You can see some of the expected revenue growth, CAGR being compound annual growth rate. So this is not going to be a single year. This is expected long term over the next 3 to 5 years. And you can see some of the expected margins associated with it. The reason why I highlight all this information is because this bodes very well for their current valuation. Again, the stock price is currently at $3.5 billion in terms of total assets. So if we keep those price to sales targets where they're at right now, a 40x price target is, or really a 45x price target is about where we're at in terms of the Q2 numbers. So that means if we have a trailing 12 months, $58 million. Again, right now we are currently sitting at right at 48. So if we have 58 to 60, that'll warrant a price target based on price to sales of 50x of right at $30 a share, which is about 10% higher than where we're at today. However, I don't think that price to sales of 50x is necessarily appropriate for a company like this. The upside, though, is if we see the full year expectation of $147 million in total revenue, then that brings down a significant portion where the price we're at today is 20x sales, but will also be a profitable company at that point in time, hopefully, or near profitability. And I think that will warrant the large increase. So if we talk about price targets based off of revenue, this $147 million in total shares that we have available right now, if we were to see that at the current price to sales multiples of around 50x, so price to sale 50, then this would put the stock share, depending on total outstanding shares at that point in time, between $55 a share and $76 a share, or which are both that's between 2 to 2.8 times higher than the current stock price, and that is incredibly attractive. So let's look at that graphically back on their chart. So if we're looking at the stock right here, again, that $40 or that $54 margin, which again, this is year end, so you would imagine that's going to be posted sometime in February of next year. You're looking at a $55 target, which is higher. That it'd be a new high for where the stock is today and be about a 90% increase from where we're at then, if we hold that same price to sales multiple. Depending on the overall outstanding shares, we could have that be as high as $76 a share if we only hit 147 in terms of total revenue, and I anticipate that they may actually be higher than that. So all that being said, when I'm talking about year-end price targets on December 31st of this year, I do believe the stock's going to be between $50 and $60 a share based on any additional news that comes out, as well as overall market conditions. Again, not a financial advisor, this is just my opinion, but the company is growing incredibly quickly, and that'll drop their total sales expectations down dramatically. The other thing that I want to highlight is this is a company that's expected to grow their total market significantly. So if we go back to their investor presentation, if we look at their long-term expectations, you can see that this is a very strong market, and I do generally think that total addressable market, or TAM, is a made-up number, but this is something that's going to grow significantly, and the capability is here, the cost expectations are there, and I do believe that STEM is a market leader. Even if they are not the market leader in the long term, 20% of the market is still massive, especially when they're expected to bring in 147 million this year. Any number larger than that is still going to be huge. You can see that right now they're a market leader. I expect that to stay. If you see this double and triple over the next few years, that's going to post directly to the bottom line in a massive way. For that reason, this is why I like the stock, and a lot of the reason why I have built a significant portion of my portfolio into STEM holdings. So if you find this type of content helpful, please consider leaving a like and subscribe, and I'll talk to you all later.